Hello, my name is Larry Kushner and I'm with Cornerstone Wealth Management Group. I'd like to welcome you to today's presentation from the State of Connecticut Teachers Retirement Board called Retirement Lane. First, I'm going to give you a little bit more background about us at Cornerstone, and then we're going to jump right into the presentation. Cornerstone Wealth Management Group is an independent personal wealth management firm, and we focus on comprehensive strategic financial planning for teachers. We've been working with teachers for many years and have given this presentation many times in schools throughout the state. At Cornerstone, we believe that a plan is a powerful tool and that our clients' long-term financial objectives hinge on having the right blueprint. What we strive to do is to give independent advice based on a holistic approach that takes into account everything that goes into your life, not just your finances. There are some common questions that we have seen when we have given this seminar. So we're going to answer some of the most frequently asked questions, and if there are any other questions that you have, we are available at Cornerstone to help you. We will give you our contact information at the end of the webinar. When you make decisions about your pension, you are making decisions that are irreversible and that will affect the rest of your life. So you want to make the right decisions. We'd like you to be more confident that you know that you've made these right decisions. Whether it is us or if you utilize the TRB directly, you really want to go and get some professional advice from somebody who not only is an investment professional, but someone who works with teachers and understands the differences in the needs of teachers and educators in terms of all their benefits and how they really fit in with everything else that you have going on in your life. But I guess the first thing I'd like to say along with that is congratulations for being a teacher. You have one of the most robust retirement systems and retirement plans that is out there that I've ever seen, and it is much more robust than you will find in the private sector. Many people today do not have a pension, so that is a great benefit that you have. Today we'll be able to go through and explain some of the differences in your plan and hopefully put you on the right path to understanding what benefits may make sense for you. Today we'll review the differences between a defined benefit and defined contribution plan, and we'll discuss the TRB eligibility rules for retirement. We'll talk about the different retirement pay plans, including Plan N, Plan C, and Plan D. We'll review supplemental and voluntary contributions, pensionable salary and credited service, and how you can go about purchasing additional credited service. We'll discuss deferring benefits as well as the taxability of benefits. We'll also discuss Social Security benefits if you've worked in the private sector, and the windfall elimination provision and government pension offset. And we'll review cost of living adjustments and what your health insurance options are. We'll also discuss disability benefits, pre-retirement death benefits, what happens if you want to go back to work after you've retired, and how you go about filing for your benefits. To start, let's discuss what the difference is between a defined benefit and a defined contribution plan. A defined benefit plan is exactly what your pension is. It is a plan where you contribute a certain percentage of your salary every single pay period, and at the time of your retirement, based on an actuarial formula, you'll have a predetermined income and retirement based on your pensionable salary throughout the course of your working years. That typically stays the same or rises a bit with cost of living adjustments, but that's not true with the cash value that's associated with your pension. The actual cash value is shown in the pension statement that you receive every year from the Teacher Retirement Board in December. If you have misplaced your statement, you can get a duplicate statement by calling the TRB at 860-241-8400 or emailing them at trb.webmaster@ct.gov. Defined contribution plans are more like the 403Bs or 457 plans or 401Ks in the private sector. Some of you may have a 403B that you're also contributing to, and that's great, because the defined benefit and the defined contribution plan really work together. The defined benefit plan or your pension can be sort of a baseline for you in terms of your overall retirement. You can use your 403B or 457 plan investment account to supplement that income throughout the course of your retirement. The main difference is that in the TRB defined benefit plan, you have a mandatory contribution of 6% of your income every single pay period to the pension. With a defined contribution plan like your 403B or 457, you define the contribution that you'd like to put into that account. You determine what percentage of your income goes into that account. Additionally, with your 403B or 457 plan, you control what your money is invested in, whereas the state has more of the control over the investment in the defined benefit or the pension plan. I will now talk about the eligibility rules for retirement. Membership and participation in the teacher's retirement system is mandatory for all eligible teachers. Eligibility requirements are as follows. 1. You occupy a position which requires you to hold certification. 2. You possess the appropriate Connecticut certification for that position. And 3. You are employed for a minimum average of half-time or greater. Your membership in the teacher's retirement system will begin the month in which you start working, provided it is on the first working day of the month. If you are employed as a teacher or professional staff member by the Commission for Higher Education in one of the state of Connecticut's public universities, colleges, or technical colleges, you have a choice of retirement plans. You may elect to participate in the teacher's retirement system, the state employees retirement system, or an alternate retirement program. If you look at the slide in the middle, you'll see that it talks about the different ways you can get a retirement pension benefit. There's basically anywhere between 10 years of service and being 60 years old or having 35 years of service or more. Anywhere in between that, you will receive some sort of a pension benefit, whether it is an early retirement benefit or a deferred vested benefit or a proratable retirement. Really what all those mean is that there's basically a fraction of what normal retirement would be. Not to go into the full calculations or anything, but if you have accrued 10 years of service and are age 60 or have accrued 35 years of service or anywhere in between, you will receive a benefit. And that's what's most important to understand about this slide. If you do not have 10 years of service, what happens at the end when you do retire is that you will receive your contributions that you put into the retirement system back in a refund. Of course, it's always best if you can to know where you are in the timeline. For example, do I need to work another year or two to get a benefit? Or how does it all work in terms of what I'm looking at for my retirement? Can I beef that up in some way by working more or purchasing the additional needed time, which we'll discuss later on in the presentation? Let's discuss the different retirement benefit plan options. The first is Plan N, and what Plan N means is that it's your normal retirement benefit, which is a full retirement benefit that is based on a single life. When you pick your retirement benefits, there are certain plan options that allow you to designate a co-participant that can also receive benefits along with you or in the absence of you if you predecease that co-participant. So the normal retirement plan will be based on one person or on one person's life. That may make sense if there's no spouse involved or if there's no significant other, or the significant other or spouse has a substantial income in retirement and maybe you just want to get the most that you can when you are in retirement. The Plan C option is called the Period and Certain Continuous option, which places benefits with the participant or with the teacher. You'll hear me say participant and teacher interchangeably. They're the same thing. What this benefit does, this Plan C benefit, it allows the participant and co-participant to receive benefits for at least a certain number of years, and if the participant lives longer, until that participant passes away. The Plan D option is a protected pension for not only the teacher participant, but for the co-participant as well, which I like to call this as a spousal benefit because for the most part it's used to protect the spouse in retirement because it's also for their lifetime. So even if the participant passes away, the co-participant gets to continue those benefits for the rest of their life. There really is no best plan. It really depends on what the circumstances are going on in your life and what makes the most sense for you to maximize and really have the best peace of mind. You need to sit down and you need to really hash out what makes the most sense and develop that peace of mind to determine how important it is that no matter what happens to you, that your significant other and your beneficiaries are going to be taken care of. We do recommend that you sit down with a professional because this decision is irreversible. You'd like to speak to a professional and really find someone who works with teachers. This slide is a sample computation. It's really not meant to be in-depth. It just shows how the different factors come into play when affecting your pension benefit. It has the member's age, how many years of service they've accrued, what their average or highest 3-year salary is, and that's a very important metric in determining what your retirement benefits are. The calculation includes how many years of service that you have, as well as your average of the highest 3 years of service in terms of salary. It includes your spouse's age. A lot of these benefits are just actuarially based. So depending on your spouse's age, that may affect the pension benefit if you would like to include them on any benefits that you'll receive in retirement. At the bottom of the page, it shows the actual pension contribution that you've put into the system, as well as a supplemental or voluntary contribution that you've put into the retirement system, and how that can be in addition to your pension if you so choose to do so. Supplemental or voluntary contributions is a 1% account, where 1% of your income per pay period goes to supplement your pension. This slide is called the plan and allowance. I like it because it sort of explains the different options of what you have for the supplemental or voluntary account and how that you can either use it to increase your monthly benefit in retirement or what else you can do with that account. As you can see, this voluntary account over the course of this particular participant's working years could add $233 to the monthly benefit that they would have received in retirement had they just contributed it to the regular pension plan. The participant does not have to utilize that supplemental or voluntary account to be contributed to the pension plan when they retire. They can also take a refund if they so choose, or they can do a direct rollover. Any pre-tax contributions, any growth of those contributions, just so you know, is taxed. There is a mandatory federal tax withholding if you choose that you'd like to do a refund. You can also do a direct rollover and put the voluntary contribution into your own individual retirement account to be used as needed to supplement your pension in retirement. There is one interesting thing to know which does give you a little bit of protection for a beneficiary if you choose to utilize the plan and death benefit. You're probably wondering what happens to all those contributions that I've contributed to the TRB pension system if I pass away early after I start taking my pension. Well, the good news is no, they don't get wiped away. In fact, what happens is actually what you see here in this specific example. Here you have a teacher who accrued $370,000 into their pension. This is the number you get from your annual TRB statement, which includes both your contributions and their growth in the TRB system. Over 30 to 35 years, this number can be very significant, and in this example, it is $370,000. Now let's say this teacher was receiving a pension of $40,000 a year, and at the end of year 4 they pass away. So they've taken $160,000 from their pension, and what the TRB is going to do is to say, okay, we're going to multiply that by 25%, and we're going to minus that amount from the total account balance that was at the participant's retirement. So the lump sum at the end, the $370,000 minus the $40,000, gives us $330,000, and that will go to the beneficiary that was deemed at the retirement for the participant. This could be a child or it could be a spouse. Let's talk about the Plan C Certain option. For this plan, there is a reduced benefit, and the reason for this reduced benefit is that it has a type of insurance built into it. You are ensuring that you and the co-participant, that you and your spouse, will receive at least a certain minimum number of years of your pension. Remember, if you as a participant live longer than those years, then you continue to receive your pension benefit for as long as you live. But it does provide a co-participant and beneficiaries some protection to receive benefits for a predetermined number of years, just in case, unfortunately, our participant passes away before they are able to realize their full retirement. You may choose a guaranteed period of 5, 10, 15, 20, or 25 years, and if you die prior to receiving all of your guaranteed payments, your beneficiaries will receive the remaining monthly payments. As I mentioned in the last slide, there is a reduced benefit. And what does that mean? Well, essentially for Plan C and for Plan D, what you're doing is you're purchasing insurance. You're purchasing insurance to protect your beneficiary in case that you pass away early. Here we'll take a look at how much that reduction factor is. And what this factor is the amount of the full benefit under Plan N, and you multiply that to show what you'll be receiving in a Plan C benefit for all those years. Now let's say the individual says, well, I really want to protect 5 years. Now I'm not sure you'll only want to protect 5 years, but that may make sense to the participant. What the TRB is going to do is say, we'll need to protect ourselves in case that does happen, where we want to have 5 years in case the participant passes away in year 1. We're going to take a small portion of the Plan N benefit. We're going to protect the pension system and provide a reduced benefit. So the Plan N base amount, which is the regular pension, which is based on a single life, that benefit would have been $5,170. You multiply that by the 99.9% to get your Plan C benefit. Now let's go down 20 years. So as you can see, as the factor goes down, what you'll be receiving in retirement is going to be less and less, because what's happening is that you're protecting more and more years. The TRB needs to take this into account, and essentially you're buying insurance to protect you and your beneficiaries for that length of years. And so, okay, this participant would like to protect 25 years of their income, and so the TRB will multiply their Plan N benefit times the factor, which will result in a Plan C based amount. They do include the supplemental voluntary account here as being added into the Plan N base amount. That number will also be multiplied by, as you can see here, the 94.7% for a Plan C annuity amount. They've added these two numbers here to result in the Plan C benefit. So whereas you would have received $5,400 a month under Plan N, you'll be receiving almost $300 less with the 25-year Plan C option, but you'll have the peace of mind and the guarantee of 25 years of your pension benefit, just in case you do pass away early. Now, I'm not necessarily recommending this. It really depends on the specific situation. This may make sense for you, and it is what it is. It's important for you to know what the different options are. Let's take a look at the Plan C death benefit. That is, what happens if the participant as well as the co-participant or spouse passes away. You need to be concerned that the rest of the payments will be lost, because that's not true. What is shown here is that after the member passes away after 100 months, that the participant starts receiving their payments, of course including COLA. That's the $6,036. Now, if the co-participant, the beneficiary, dies with 50 payments remaining, what the TRB does is they commute the value of those 50 payments at $6,400 a payment. That includes the COLA increases, and they multiply it by an actuarial factor, and they end up with a payment to the estate of $272,000. And that brings us to the Plan D benefit. Plan D is similar to Plan C in that you're protecting someone else, not just you as the teacher for your retirement. Under this plan, the co-participant receives a monthly benefit no matter how long they live. It's not yearly based, it's basically life based. If the participant passes away, the co-participant lives for 30, 40, or 50 years, it doesn't make a difference. They will receive a benefit for as long as they are alive. In this plan, you deem a certain percentage of your pension that you'd like to protect for that spouse for their retirement. As the co-participant, they can receive 1/3, 1/2, 2/3, 3/4, or the whole amount of your reduced benefit. That's why I'd like to call it the spousal benefit or the significant other benefit, because typically that's what we see in terms of why people pick Plan D amount. They want to protect their spouse or significant other, and they want to have the peace of mind knowing that they're going to take care of their spouse no matter how long they live. The benefits aren't going to stop. The benefits are reduced based upon your age, the age of the co-participant or spouse, and a fractional amount that will be paid to the co-participant upon your passing. So here you see a table which is similar to the Plan C table in terms of the factor based upon how much you'd like to protect. What it means is that you have a Plan N amount for your pension, which is in this case $5,170. And then you have your supplemental annuity pension of $233. And it gets reduced by a factor based upon what you would like to protect. So look at the left column, which the TRB mislabeled in terms of years. And if you'd like to protect half of your pension as supplemental pension for your spouse, the factor is 95.1%. Or your pension is reduced while you're alive by 4.9%, and then when you pass away, your spouse or co-participant is receiving 1/2 of the pension that you've received. If you want to protect the whole amount, that is, you want your spouse or co-participant to receive the same amount of your Plan N and supplemental pension, then the factor is 90.5%. Or, while you're alive, your pension would be reduced by 9.5%, and then when you pass away, your spouse would receive the exact same amount for your pension and supplemental pension. Of course, also increasing by COLA amounts. So let me repeat that again. You have a factor and you're paying insurance to the TRB to protect your income for you and your spouse for the rest of both your lives. You multiply that by Plan N, and then you pick out what percentage you want to protect, and you have a reduced benefit while you're alive, and then it's protected based upon the amount that you're protecting, the 1/3, 1/2, 2/3, 3/4, or whole amount when you pass away. One of the reasons why this benefit is attractive is because it provides a little bit more flexibility to a couple in situations depending upon what their needs are, depending upon the status of the spouse, depending upon what the income is of the spouse, and that they can be taken care of. Maybe, based upon the needs of your spouse and their income in retirement, you don't need to protect the whole amount. Maybe you only need to protect 75% or 2/3 of it. The TRB is pretty flexible in allowing you to select different amounts that you'd like to protect. As I mentioned before, the decisions that you will make about your pension benefit, that's Plan N, Plan C, or Plan D, are irreversible. That's why it's important to plan in advance to make sure that you're making the decision that is right for you. The one benefit that you do have is with Plan D that gives you a little bit of protection is if the co-participant, let's say it's your spouse, predeceases you. Then the plan amount pops up. It's called the pop-up provision, and it pops up to the Plan N amount. You will receive the Plan N amount if your spouse predeceases you or divorces you at any time during your retirement. Similar to Plan C, there is a Plan D lump sum death benefit if both the participant and co-participant pass away. It's a lump sum that's paid to the estate or to another beneficiary, and it's similar to the Plan N amount. The TRB takes a look at the benefits that have been paid, they multiply them by 25%, and then they reduce the account balance at the retirement of the member, and that's the amount that you get. Again, that amount is the amount that's shown on your annual TRB statement, and it's the amount that you put into the system as well as how much it's grown. There are 3 ways to make voluntary contributions to the voluntary account. The first way is through payroll deduction. That's the 1% that you can put into the voluntary account. Payment is withheld by your employer and transmitted to the TRB on a monthly basis. The second way is a lump sum voluntary payment. Payment is made directly to the TRB. And the third way is through a direct rollover of pre-tax contributions from another qualified employer plan. That would be a 401k, a 403b annuity, a 403b custodial account, a non-Roth IRA, or a 457 plan. Voluntary contributions that are submitted via payroll deduction or through lump sum payment are made only on an after-tax basis and are subject to IRS limitations. The direct rollover is of pre-tax contributions, and they're from other qualifying plans, and they're based upon a qualifying event. They can be based upon termination of prior employment or based upon retirement. And pre-June 30th balances are credited with an investment rate of return. That was changed back in 2007, where the voluntary account prior to that was done according to a smooth rate of return, but in 2007 it was changed to an investment rate of return. We're now going to get into pensionable salary and credited service. What this means is that you receive a pension benefit based upon working as a teacher, administrator, a supervisor, anyone who's under the TRB system. It doesn't include if you're a coach, any extra duty, any bonus pay you have, or any unused sick leave, terminal pay, or anything like that. Pretty much just your base income, which is where the 6% comes off of, and that you see coming out of every pay period. You earn 1 month of credited service for each school month work from September to June. A full year of service is 10 months. 10 months is a full school year. Part-time service. There's a lot of confusion between the difference between part-time and half-time and under that and what all that means. Part-time means that you worked 50% on average of every working day, every working week, every working month. It's not that you worked 5 months and then took 5 months off for maternity leave or something of that nature. because in that instance, if you worked 5 whole months as a full-time teacher, that would just go towards half a year of your full-time teaching. The part-time service is where you're working a reduced work schedule that's at least 50%. The way the TRB views it is that if you worked as a part-time teacher, your retirement benefit, should you qualify, will be deemed what your full-time equivalency is, and that amount will be multiplied by the amount of your part-time service that you had, be it 15%, 50%, or 70%. They multiply your full-time equivalency, which is your full-time benefit, by how much on average you've worked, which is deemed by the school board. If you're an hourly paid tutor, Title I, Chapter 4, or CETA Head Start, or ESL service, then you need to and you want to receive pension benefit or pay into the system, you need to submit a form called the Hourly Paid Certified Teacher Form. You won't be able to click on this, but we can point you in the right direction if you need to get a copy of it. If you're going to be taking a leave of absence for whatever reason and you still want to receive your retirement benefits during that time and pay into the TRB system, you need to fill out a current leave of absence form, and you need to work out with the TRB and your school a payment plan to be able to pay into the retirement plan while you're taking that leave of absence for whatever reason it is. You can pay the monthly mandatory contributions while on your approved current leave of absence for a total of 10 months during your career for any leave occurring after July 1st, 1986. And again, you need to fill out that current leave of absence form, and you need to pay into the TRB system during that period. There are additional areas where you can actually purchase service credit. In certain situations, it may make sense for you to purchase years of service for different public service that either has occurred in the state of Connecticut or outside the state of Connecticut. Examples are wartime military service or peacetime outside of Connecticut public schools. And we've had situations quite often where you have teachers who have service in Rhode Island or Massachusetts or New York or other states, and they switch very early in their career to the Connecticut system. Well, what you need to do is you need to fill out a specific form based upon what the type of service credit is that you're looking to receive. Here are specific examples. And here are more examples where you can purchase credit, whether you've been a substitute teacher, if you've served as an elected official, if you've been in the Federal Teacher Corps, Peace Corps, if you've been a social worker assistant, or if you've been in VISTA, or if you've been a part-time lecturer in Connecticut, or if you've had an adult education assignment for high school credit diploma, but not for GED. Lastly, you can purchase additional credited service if you have hourly paid certified teaching service as a tutor or through CETA, or if you've worked for the state of Connecticut, whether it's teaching at UConn and another college, or if you've worked at a state of Connecticut agency, DOC, DMR, or any other agency. There's a specific form for the type of additional credited service you're looking to purchase. If you have any questions, or whether you're not sure of outside service and if you qualify, please let us know and we can help you with this. This is an interesting slide. It's a calculator for additional service credit, and it's a cost estimator as to how much it would cost for purchasing service. It's located on the Connecticut TRB website. This is important if you're thinking that buying service is something that you want to do. With this calculator, you can put in the numbers to determine what the cost of that service is going to be and for how many years that you can purchase. You can see right at the top it says the member of cost of service purchased, and it will appear in red. and it says X number of dollars is needed to purchase that number of years of service credit. It's a neat little tool to help you understand some of the options that you have and what purchasing service may cost you when you choose to do so. You can then go in and see what the benefit is by looking at another calculator as to what it will increase your pension when you have additional years of service credit. The TRB does want you to use caution when you decide how to make sense about retirement. There are certain benchmarks as to when you retire, when you get to normal retirement or early retirement, that are important to really know and evaluate depending upon where you are. You may be a year away from qualifying for normal retirement, and depending upon whether or not you take it at a certain age or wait a year, it can have a very significant impact upon what you're able to do in retirement. In the example that you see here, you have a member who is age 53 with either 29 years of service or 30 years of service. And you can see with the early retirement percentage, the individual only needs to work one more year, and it equals almost $13,000 more in retirement. If they retire with 29 years of service, they'll only get $38,280. However, if they wait one more year, they'll get $51,000, a very, very significant difference. This slide is not meant to lead anyone down a certain path, but it is to explain the different options and how they can affect your retirement situation. Here you have a teacher who has 30 years of service, and their average highest 3 years are $100,000. The difference here are the ages. You have one teacher who's 55 and one teacher, or the same teacher, who will be deferring to age 60. It shows you basically the differences in what actually was received by that participant over the course of their retirement. In the first example, you have the base percentage because it's an early retirement, so the factor is reduced by 51%, which means this individual received $51,000 as a plan and benefit for the rest of their life. The second example shows that individual waiting 5 years until age 60, receiving a normal retirement benefit and receiving $60,000 a year for the rest of their life. So the early conclusion may be, why not? Why don't I just wait until age 60 and receive $9,000 more a year and have a higher living benefit for the rest of my life? Well, that may make sense, but understanding that during those 5 years you were basically sacrificing that annual benefit, and you wouldn't have received it for those 5 years, which equates to $255,000. The little key at the bottom shows how many years you'd have to live in retirement in order just to break even on forfeiting that amount. In this instance, you'd have the $255,000 and the annual benefit of $9,000, so that when we divide them, you get a break-even point of 25 years. What this means that if you choose in this instance to defer your benefit to age 60 with those 5 years, this individual would have had to live at least 25 years just to break even with not taking the benefit at age 55. This is just an example, and it's not meant to say that age 55 makes more sense than age 60 or vice versa, but you'll run into examples like this. One interesting thing to note is that if you have service that's before July 1st of 1991, contributions before that date were made on an after-tax basis, and after that date they're made on a pre-tax basis and are not taxed by the federal government before they go into your pension. After-tax contributions are not taxable in retirement, whereas the pre-tax contributions that you're making today are taxable in retirement. A portion of your benefits may have been before 1991, which means that they may be after tax, which means that you won't have to pay tax on them in your retirement. Depending upon your age, there's a certain actuarial amount. In this example, it's 310 months, so that because they had $40,000 or $44,000 of after-tax contributions, they divide that by the actuarial amount of how long this person is supposed to live in retirement, and that will give you a certain non-taxable benefit every month. Once those 310 months are satisfied, all the benefits that you receive are assumed to be pre-taxed, and you'll get taxed on the full amount. Now we come to Social Security benefits. One big question that always comes up with teachers is, my spouse has a Social Security benefit because they worked in the private sector for their whole life. How does that affect my pension? Well, it never affects your pension. Social Security does not affect your teacher pension. It actually works vice versa. Your pension benefit can affect your Social Security spousal benefit. In this case, if your spouse passes away and they worked in a private job and had Social Security, the federal government does not want you to double dip. What they'll do is they'll take your spousal benefit and they'll do a calculation where they'll minus 2/3 of whatever your TRB pension benefit is. If there's anything left over, that's what you'll receive in your spousal benefit. For example, if you're eligible for $600 a month spouse, widow, or widower's benefit from Social Security, but if you receive a monthly TRB pension of $5,170, as shown in this example, what they'll do is they'll take 2/3 of that, or $3,412, and subtract it from your spousal benefit, or in other words, you'll get zero. If the government employee worked instead of and had been subject to Social Security taxes, any Social Security benefits payable as a spouse, widow, or widower would have been reduced by the person's own Social Security retirement benefit. In enacting the government pension offset provision, Congress intended to ensure that when determining the amount of spousal benefits, that government employees who do not pay Social Security taxes would be treated in a similar manner to those who work in the private sector and do pay Social Security taxes. Well, as I mentioned in the beginning of the presentation, your TRB benefits are very robust. While negatively affected in this case if you have a spousal benefit, and in most cases, and I won't say all, but in most cases, you most likely will not have a spousal benefit because your TRB benefit pension is just too large, even at 2/3, typically for a spouse to be there. Now, in some cases, there may be, depending upon how much service you had as a teacher and how much your spouse worked, but in general, this severely reduces and even negates the spousal benefit. Feel free to contact us and we can explain this in more depth for your specific circumstances. The windfall elimination provision is similar, but it's not based on your spouse's working history, it's based on your own. Some teachers prior to teaching worked in the private sector and are eligible to receive a Social Security benefit in retirement because they have paid Social Security for more than 40 quarters while working in the private sector. The windfall elimination provision is basically the government not wanting people to work in a private job for a reduced amount of time and then working for the government and receiving full Social Security benefits. You can go onto the Social Security website at ssa.gov and you can calculate what the reduction to your Social Security benefits are by registering to get your statement and then using the calculators that are on this website. The maximum reduction for 2013 is $395.50, which would be deducted from the amount that is shown on your annual Social Security statement. If you have any questions on this, or if you would like us to go through a calculation, feel free to contact us and we will give you our contact information at the end of this presentation. Let's talk about cost of living adjustments. The maximum annual increase that you can receive is 6%. If the retirement fund earnings in the TRB system for the prior year were less than 8.5%, then the cost of living increase is capped at 1.5% for the next year. This chart shows you a history of the cost of living increases over a decade. And as you can see, it's averaged around 2.5%. The average cost of living has actually increased at 3.74% during this period of time. If you are not participating in Medicare Part A hospital insurance and Part B medical insurance, you and your spouse or civil union partner can elect to continue your health insurance with your last employing school district. You must be offered the same coverage that is available to active teachers, and the TRB will provide a monthly subsidy of $110 for the retired and a subsidy of $110 for the spouse or civil union partner of a retired member, which is applied towards the cost of coverage. Subsidy must be applied first to the member and the spouse's cost, and the election to enroll may be deferred. The premium charged to a member cannot exceed that charged to the employer. That is, no administrative fee is allowed. However, keep in mind, as a teacher, you're probably used to receiving a significant subsidy from the school district, and the school district will no longer be subsidizing it. The subsidy will be the $110 for you and your spouse from the TRB, or $220 collectively. If you decide to participate in Medicare Part A and Part B, then the TRB offers a Medicare supplemental plan, which is for retired members and their spouses. The basic plan includes hospital, medical, major medical, and prescription drug benefits, and the individual cost in 2010 was $112 per person per month. Also, your school district or the TRB can supply you with dental insurance, and through the TRB, if you're going that route through participating in Medicare Part A, Part B, the cost for dental is $160 per person per month. The Medicare Part A, Part B, if you are electing Medicare Part A, Part B, then the supplemental plan with dental, vision, and hearing is $165 per person per month, or $330 for you and your spouse. And the state, the member, and the health fund each pay 1/3 of the premium cost. The health fund assumes the state's share in years when the state's contribution is not included in the state budget. This is the 1.25% that is being taken out of your paycheck today above the 6% that is used for that subsidy. Although disability benefits don't necessarily pertain to you in retirement, we do want to take a moment talking about them for those teachers that are a number of years away from their retirement, to talk about how they can affect your retirement benefit. For the first 24 months of disability, it means that you're unable to perform your duties as a teacher because of a physical or mental impairment, which is expected to be of a long duration or result in your death. After 24 months, disability means that you are unable to perform any substantial work activity. What that means is that you're unable to get another job beyond that of a teacher after 24 months. For each year of full-time credited service, the benefit would be calculated at 2% of your salary base. The minimum benefit percentage is 15% and the maximum is 50%. Service credit will accrue to a maximum of 30 years while receiving a disability allowance. Once you obtain age 60, or a minimum of 20 years as a teacher, the disability allowance is then converted to a normal retirement benefit, at which time you'll be required to select a payment plan. The converted benefit includes any cost of living adjustments accrued while on disability. If you have any further questions on this, again, feel free to contact us. Earlier, we mentioned some of the benefits after you retire should you pass away, but the pre-retirement benefits shown here, they're very similar if you've seen a Social Security statement in terms of how they're set up and who they pay out to if you do pass away early. Here are some of the options that you have. One of the things that's interesting here is for people who are eligible for retirement, even if they haven't retired yet, is that your spouse can choose a Plan D whole amount should you pass away. That's one interesting thing to note, and it does offer your spouse or co-participant some protection that they can take the Plan D whole amount. We often get questions from retired teachers that are interested in gaining reemployment within the Connecticut teacher retirement system. A retired member may be reemployed as a teacher or administrator in the public schools of Connecticut and earn up to 45% of the maximum salary level that's established by the school district for the position occupied. This limitation is on a school year basis. The employing school district has to fill out a form and notify the TRB as to this employment. However, a retired member may be reemployed in a designated subject shortage area or a school in a priority school district and continue to receive their pension income for a period of 1 year. And with prior approval by the TRB, the reemployment can be extended for an additional school year. Again, the employing school district must submit a form. When reemployed in a designated subject shortage area or school in a priority school district, the former teacher shall be eligible for the same health insurance benefits provided to active teachers employed by such school system. During the period of reemployment, a health insurance subsidy payment will not be issued by the TRB to the school district. Finally, filing for retirement benefits. You need to file, and the latest time that you can file is the last day of the month preceding the month that you'd like to retire. I would strongly recommend that you do not wait that late. You want to talk with your school district, you want to get your ducks in a row and get all the information that you need. You want to understand the benefits that you're going to be receiving, but that's the latest deadline. So there's late filing and there's lost benefits. Make sure you do your homework here and get things lined up before you retire. You'll need a birth certificate and any other documentation that's required by the Connecticut TRB or the school directly. At this point, you should really know more than what the different benefit options are and the choices are. We understand there's a lot of different options that are out there, so we do encourage you to do your homework, and thank you so much for being here on this webinar. And we'd like to review some of the frequently asked questions before we wind up today. The first question that we commonly get is with regard to working in two different states. Most teachers want to know how it affects their benefits and how they can combine the service in both states. Well, it's actually a much more complicated question than you might think. There's different factors that determine your choices and what they're going to be, as well as the portability options in each state, the cost of purchasing outside service, what impact it will have on our benefits through purchasing those years. It really depends on the state that you're trying to combine with Connecticut, and you might be able to get what's considered a full retirement benefit at different levels of service and with varying costs. It's a very loaded question because every state is a little bit different, but there is potentially options for you to combine. But again, it's best to talk to someone that understands not only Connecticut, but can also get the information from the state that you came from. The next question that we often get is, I had to take a leave of absence for having children and I was out of combined total of 2.5 years. Can I purchase that service? The answer here is maybe. You might be able to purchase those absent years if, and specifically if you filed a maternity absence paperwork with the Connecticut TRB and you worked out payments for those lost years ahead of time. It's unfortunately, but currently the TRB does not allow for purchasing years that aren't cleared with the TRB before the absence occurs. So this one of a kind, did you file or did you not? But it's a unique situation, and it currently stands after the fact. Going back to those years without having done the paperwork in advance won't allow you to purchase those years of service. Now this is for maternity absence. If there's other work history that you have, for example, if you're in the military or the Peace Corps, then obviously they aren't going to be given to the TRB beforehand, since you were never a teacher at that point. But depending upon the leave of absence depends on whether or not you can purchase it earlier or later. We see the maternity situation most often, but we also see military service as being very common. For that, there's different areas. So depending upon what kind of service, wartime service, peacetime service, there's different rules. You'll definitely want to find out what those are, and we can help you with that. The next question is, can I take my retirement pension and continue to work as a teacher? Well, the short answer is yes, you can. You're allowed to work part-time, which means 45% or less, as a professor or as a teacher or in any capacity in any school without disrupting your pension payment or credits. As a full-time teacher, there's a few options that you have. We understand that sometimes it's difficult to be in retirement after teaching for many years, and many teachers want to go back to teach. You retire, you can't get it out of your blood. Well, there's a couple of options you can choose should you take your pension and you want to come back full-time. On the TRB website, on the home page, at the bottom of the page, from time to time, there is a list of certain subject shortages that the TRB is looking for and that they need teachers to fill across the state, where you may be able to lend your services to the school for up to 2 years of full-time service without affecting your pension benefits or credits. Because of the demand, the state would allow you to do it for 2 years. Once you do that, then you're done. You're actually allowed to work as a teacher full-time without restriction for as long as you'd like at a private institution or an out-of-state school. Basically anything out of the TRB system, and you can work full-time. Theoretically, you can work at any school that wasn't connected to the TRB. You could work at a religious school, or you could work in another state. Any of those would be fine if you'd like to continue working. Well, with that, I think that's it for questions for now. If you would like to speak with me regarding your own personal situation, I will leave up my contact information for you to contact me. Whether retirement is 5 years away or you're planning to retire this year, the earlier you start to plan, the better off you will be. Learning the details of your retirement benefits is only one piece of the picture. Seeing what other things you have going on, other investments, and if you have a spouse, how it all fits in with your benefits and how everything works together can really lead to a very successful and happy retirement.